Thanks, Kyle. Well, I'm really excited to be here with a bunch of finance and insurance people because that's kind of my blood, numbers. And do you realize that we are, as a nation, are producing record amounts of output? Our output is record-breaking. We produce more output in the United States than any country has produced in the history of the world. So we produce most output. What else do we got going for us? We got record jobs, and we have the new fiduciary rule coming, right? Yeah! Well, I thought there'd be a big explosion. Yeah! Right. All right, well, I'm here today this morning to talk about the economy. So on the program, you might think it's money, banking, and the Federal Reserve. That is the breakout session. The overall session is on the economy. And the big question for all of you is, are you prepared for what's coming? Now, I'll give you some insights on where I see the economy headed, but it's up to you to figure out, based on that, how are you going to advise your clients in face of what could possibly happen in the economy? Now, let me ask you a couple questions, if that's okay. How many people here think a year from now, they'll have more clients than they do now, more, less, or the same? How many think we'll have more clients next year for you personally? That's about 40, 50%. How about you're going to have fewer clients a year from now? One. All right, well, that's a good sign. We got most of the people here saying we're going to expand. We're going to continue this economic expansion. That's a good sign. Now, let me ask another question. What comes after an economic expansion? Contraction or recession, right? Kind of afraid to say it. So where are we headed? We're headed towards a recession, right? Oh, kind of, I don't know what's more depressing, that we're producing record amounts or that we're heading into a recession. Now, most people don't think about that. So how many people think, what do you mean, heading into a recession? We're in a recession right now. A couple of you think we're in a recession right now. How many think we'll be in a recession this year? A few more. How about 2017, a recession in 2017? A few of you. How many think we're never going to have a recession again? This time is different. We're never going to have a recession. No? So you're kind of thinking, oh, the recession's out there a few more years. All right, well, first we're going to talk about the economic outlook for this year. For the world, United States, Minnesota, and some sectors. Then we're going to look farther out, midterm, of what's the big trends that are facing us. Okay, short-term outlook. The world economy, it just continues to grow. This chart here shows that per capita, real GDP, continues to grow in the world. It has grown for a long period of time, except for that worst recession we've ever had in our lives. It was a worldwide recession, that one little blip, but otherwise the world economy just continues to grow. And that's what's going to happen again this year. I'm really, really confident that the world economy is going to grow this year, maybe 2 to 4%. I'd be really shocked if it didn't grow between 2 and 4%. Where's that growth happening? Well, India, they're forecast to grow about 7.5%. The Indian numbers, do you trust them? Maybe, maybe not. Maybe in reality, if they really accounted for it correctly, they're going to grow at 5%. But still pretty solid growth in India for a very large population. China, the growth is slowing a bit. You trust the Chinese numbers? Maybe, maybe not. But they're still going to experience solid growth, it looks like. However, there's a lot of signs in China right now that they're softening. And they're very concerned about that when you're growing at 7, 8, 9, 10% for decades, and all of a sudden you have slower growth. Is the end going to happen where they're going to have a correction? Okay, how about the United States economy? We've been in a long expansion. After that terrible recession that we've had, we've been in this expansion. Growing. Again, what comes after growth? Recession. I want to temper that because there were several years that we were growing after the Great Recession where everybody was down in the dumps. They're just walking around going, oh, this recession. I'm going, what are you talking about? We're in expansion. We're producing record amounts. No, we're in this recession. We're in this recession. Now that we've been in expansion for so long, not many people see a recession coming. So be careful. Be prepared. What is the outlook? Based on historical information using Bayesian vector autoregressive methods, which I'm sure you're all very familiar with, the forecast is for sluggish growth around 2% in the United States. The dark blue is a 70% chance. So there's a 70% chance we'll be between 4% growth and a recession, 2% drop. There's a 90% chance that will be between robust growth of 8% and a bad recession of -4%. So that means there's 1 out of 20 chance that we could just have a really terrible recession. Or there's a 1 out of 20 chance that we're going to do really, really well. But I just wanted to give this because most forecasters, they say we're going to have 1.976% growth. There's a range here. And that's starting from my theme of be prepared. Make sure your clients are prepared. As we go through this, we'll give several scenarios of where the economy is headed, and you can think to yourselves, how do I adjust my clients' portfolios, my advice to the clients based on these potentials? I was speaking with John Dean beforehand, and he was giving great advice. He was saying, hey, we're still going to be making money if you adjust to what is happening in the economy. And so if you're blindsided and go, oh, I didn't realize recession was here, well, have a plan B or plan C so that if a recession does hit, you know how to advise your clients. Now, forecasters, economic forecasters, don't do very well in forecasting. Even just a short term of like what's going to happen this year or this quarter. This chart here shows in the brown, that blue shaded area, the top 10 and top bottom forecasts by economists of where the first quarter GDP numbers are going to end up. The Atlanta Federal Reserve Bank has this thing called GDP Now. Has anybody heard of GDP Now? Nobody. Okay. Well, GDP Now says, to heck with forecasters, let's look at actually what the data does. The data comes out, and all that data is put together into the GDP numbers. And there's lots and lots of reports that go into the GDP numbers. Well, by now, we have most of the reports in. We only have like 3 more reports before the GDP numbers are released at the end of the month. And based on those reports, that's the green line way at the bottom. It looks like growth is only going to be 0.3%, not 1.5%. Now you see how the forecasters start adjusting their forecast based on the data as it comes in. And what you see is that they first started out going, we're going to have 2.5% growth in the first quarter. And now they're saying, oh, we're going to have 1.4% growth in the first quarter. Well, based on the actual data that's come in so far, it looks like we're only going to have 0.3% growth, which is really, really close to 0, right? And then when you start going negative, then you start talking about recession. Are we in a recession now? There's an indicator that tries to determine if we're in a recession right now. And they say, oh, it's a very small chance that we're in a recession right now. But look at those recession lines. It goes like way up right away. It goes from 0 to 100 in no time. So we could be in a recession this year. How about inflation? The outlook for inflation is pretty tame. The Federal Reserve's got a target of 2% inflation, whereas the statistical models are only saying 1% inflation. Again, you got the dark shaded blue, which is a 70% chance, the light shaded blue, 90% chance. So I was reading a book called Anti-Fragile. And the author there was saying you got to watch out for black swan events. Things that just come up from behind you with a baseball bat and bash your head in. And he was arguing that the Fed's policy of pushing out money, pushing out money, pushing out money, low inflation, low inflation, low inflation, low inflation, low inflation, could all of a sudden be the bang, lots of inflation. So that's another thing you got to think about for your clients. What happens if we go into a recession? Or what happens if we have lots of inflation? How do we adjust our advice? Unemployment rate is expected to hold pretty steady. Now, the growth across the nation varies tremendously. You look at GDP by state and the changes, that's what this chart shows. This is back in 2014. We don't even have 2015 data yet. We had to wait till June to get the 2015 data. But it shows that North Dakota was growing in 2014. Is North Dakota growing now? No. They, a few years ago, were growing at 13%, and then 10%, and then 6%. Last year, they were probably flat to down. This year, probably down further. But what you can see from this map is that GDP varies across the United States. We're lucky to be in Minnesota because we're above average in Minnesota. Above average income, above average education, above average workforce participation. Now, that wasn't always the case. Back in the 1950s, we were below average. And our forefathers made great investments that are still returning dividends to us. And we're reaping those dividends. What kind of investments do they make? Anybody? Where do they increase their spending for the state? Education, technology, infrastructure, healthcare. So there's a lot of talk about, all this borrowing that the government does. Well, if the government does it right, just like you all do, if you do it right, if people borrow, they're paying a low interest, and what they invest those dollars in, they're getting a high return, then it's good for the economy. Now, optimism, this is survey results of optimism over a long period of time. And a year ago, optimism was sky high, record levels for businesses. And you'll notice that when optimism peaks, it falls because we go into a recession. People become over-optimistic and they overextend themselves, they overinvest, and then when reality hits, we get into recession. Now, optimism has been falling a little bit late. Is that the precursor to us going into a recession? Possibly. The stock market. It's one of the nice things I can talk about now. A year ago, I was employed at the Federal Reserve, and they said, don't talk about stock markets, don't talk about interest rates. And last June, I retired from the Fed. Yeah. And now I can, talk about the Federal Reserve, and I can talk about the stock market. And if anybody's tried it, I highly recommend retirement. It's very nice. This chart here shows the stock market over time. This is the overall market, the Wilshire 5,000 companies, aggregate value. It goes up, it goes down. It goes up, it goes down. It goes up, it goes up, it goes up, and now it's kind of shaking around, and now it's up again. So what's going to happen to the stock market? Anybody want to make a prediction? It's going to go down? Say again? Down 50% in a year. Wow. Anybody else want to make a prediction? Well, I actually have some data because people bet what's going to happen to the stock market through options. Does anybody do options here? Calls and puts? All right, we got one person. So basically what you can do with your money is say, hey, I think the stock market's going to go up by 10%, or I think the stock market's going to go up by 20%. I can sell a call or a put, or I can buy a call or a put. And based on that, if you take a look at everybody's bets out there, you can add all those bets up and mathematically figure out the probability based on people's betting of what's going to happen in the stock market. So right now, this chart shows that there's a 13% chance of a 20% drop or greater. So you're saying a 50% chance or 50% drop? That's probably about a 7% chance of that happening. Now this shows it over time. So right now it's at 13%. A little while back, there was a 17% chance that we were going to have a big drop in the stock market. Well, how about the opposite? How about if we say, what's a chance that we're going to have greater than a 20% increase in the stock market? There's only a 4% chance that we're going to have a greater than 20% increase over the next 12 months. And this goes up and down over time as well. Now, you notice just a couple months ago, people were betting that it was going to go up. And remember, a couple months ago, the stock market was down pretty significantly. So if you put this all together and you put it into the overall densities for all the possible ranges, it shows that this isn't a normal bell curve. This shows that it's got a fat tail to the downside. So there is, on median, the median of all the percentage changes is a 4% increase in the stock market. This is the S&P 500 now. So the mean, though, the average, is negative, a negative 0.6%. So if you put all the mathematical equations in and you said, I figure that this is what's going to happen in the stock market, on average, you're going to lose 0.6%. But 58% of the time, or the 50th percentile, you're going to be gaining 4%. So in other words, you have a small probability of losing a lot, and you have a big probability of not gaining that much. But you don't advise your clients based on what's going to happen in the next 12 months, do you? You don't try to time the market, except for you that are doing the options, which is good. I love options. So you've got to just believe that over a long period of time, just like historically, that over a long period of time, the stock market is going to give nice returns. Even though you're going to have years where it drops a lot, and you're going to have years that it increases a lot, if you stick with it over a long period of time, the stock market should do okay. Is that about right, John Dean? You agree with that? Or unless you're thinking about retiring next year or something, then you're probably going, well, wait a minute. It could drop this in the short term, it can really affect me, because in the long term, we're all dead anyway, right? Any questions on the stock market before we move on? Okay. Let's talk about interest rates. This chart shows here the central banks from around the world, and when they tried to raise interest rates, what happened? Bank of Sweden decided to drop rates again. The European Central Bank decided to drop rates. The Bank of England decided to drop rates. The Federal Reserve recently increased interest rates, and they said, oh, we got a path that we're going to increase rates for a few percent here and a few percent there, and we're going to be up 3 or 4% in a couple of years. Well, guess what? They're probably facing the same trends that the rest of the world are facing, and they're looking at not increasing interest rates very much, especially if we get a lot of volatility. Now, volatility lately has gone down. The VIX, which is a measure of overall stock market volatility, is around 13 now. Just a month ago, it was like 22. So it seems like the market's getting a little bit complacent that oh, things are going to be fine, the Federal Reserve's not going to increase interest rates, volatility is down. That's something you got to be afraid of, right? Because shocks do happen. And when you have low volatility for a long period of time, watch out, because then any little ripples in the market can really throw volatility for a loop. Banking across the world, banking stocks have been taking a hit. Let's turn to Minnesota. 5.5 million people produce about $316 billion worth of goods and services. We'd be ranked, what, about 34th largest country in the world, ahead of Malaysia, if ours was a standalone economy. So we're very productive here in Minnesota. We have about 3 million workers. Unemployment rate's really low. Here is the breakout of the economy here, based on value added. Notice that finance and insurance, a very important part of the economy. About 7.5% of the value added in Minnesota is due to people in this room. Finance and insurance. This is a very well-diversified economy. The economy here is, at this level of breakout, is pretty similar to the United States economy. Any questions on the overall Minnesota economy? Where's agriculture? Agriculture is like its smallest sliver. You can't even see it. I put it in here, and it's like right between the yellow and the blue there. Can you see that little sliver there? It's like 1% of the economy in terms of value added. However, agriculture plays an important role because what they produce has to be transported, which is in transportation. It has to be stored. There's wholesalers, there's retailers, there's manufacturers, food manufacturers. So the overall impact of agriculture is pretty significant in Minnesota. It's just how you calculate the value added. Unfortunately for agriculture, they're squeezed. There's thousands and thousands of farmers and ranchers out there that don't have much market power, so they accept the prices of what the seed companies tell them. And they accept the prices what they sell their products to in the grain elevators, because those are very market concentrated, so they kind of consume all the value from this type of accounting. When you have lots of volume in agriculture, when they have good yields, that's good for the overall economy, because that means there's going to be a lot of processing and transporting and all the stuff down the pike, as well as inputs. Now, ag might have a bad year because of lower farm prices. Prices they receive for their goods and services are low, so they might be hurting, but the government seems to have a safety net for them to help them out. What we have to really watch out for is if we get a drought and we don't have much output, then it affects the economy a lot more.
What percentage is government? What was that percentage for government, say, 15 years ago?
What's percentage for government? Government has gone down a bit. It's about, I think about 12 or 13%. It used to be like 15, 16%. The way they calculate that is primarily through value added, which means pretty much salaries in the government side. So if you pay a government worker $50,000, is that the same output that they're producing as when they pay you $50,000 out in the market? So the number's a little bit fuzzy. I mean, the methodology isn't perfect, but overall, the government share is shrinking from the overall pie.
Is that because the pie is growing?
This is because the pie is growing. Could I define what GDP, gross domestic product? It's a rough value, the total value of goods and services produced in the economy. For the United States, they talk about business investment, consumption, exports minus imports. But there's another way of calculating it, and that is, let's take a look at every single industry and the value added that they put, and those two numbers should be the same. And that's what we do at the regional level for states. Does that answer your question okay? Could you rephrase the question? Maybe I could try to... Output, yes. So it's not sales. So let's say Minnesota produces $9 billion of agricultural products last year. That $9 billion isn't the value added because they're paying for seed, which would be in a different area. They're paying for transportation, which would be in the transportation area. So it's basically how like the Europeans calculate a value added tax. It's the value added in each of these sectors. And it comes down to primarily to the salaries of people in that area, amount of income that comes in from the people that are actually producing. Pretty much. There's a capital component as well.
Where does teaching fit in? School, public schools, universities?
That's in other. And there's a little bit of it in government, I think, but most of it is in other, separate category of education. That's a big component. It's almost as big as healthcare. Should we move on? Okay, so what is going to happen in the Minnesota economy? This is the index of leading indicators produced by the Philadelphia Fed. Shows that North Dakota is looking like they're going to be losing. Their leading indicators aren't very good. Minnesota looks like it's going to continue to grow, as most of the nation. So overall, it looks like the economy is going to continue to grow in the nation as well as in Minnesota. Expect jobs to increase pretty robust, about 1.9% this year in Minnesota, which is a lot higher than the population growth. Okay, let's take a look at some specific real estate sectors, if that's okay. Here is the life cycle, which they have it in a circle, of commercial real estate. The life cycles of real estate are all the same. What you have is you have a recession. A recession is when rents are going down, occupancy is going down, employment is going down, no building going on. After recession, you have recovery. Recovery is rents are still down, but you're starting to see some absorption happen. You start seeing more occupied things happen. You're starting to see employment go up a little bit. Then you have expansion. Expansion is rents are going up, occupancy is going up, buildings going up, employment's going up. We're in expansion. And then you have an area called hypersupply. Hypersupply is where your occupancy is going down, the rents are flat to going down, yet you're still constructing more stuff. How does that happen? Well, in the expansion phase, the market gets signals. People get signals. Hey, I could make money. I should diversify my portfolio and put it into real estate. Because if we build a new building, based on the rents we can get and the cost of the new building, we should make out like bandits and we'll have 15% returns. So by the time you figure that out, you buy the property, you get all the permits, you build it, you fill it up with stuff, and you fill it up with people, it might be 3 or 4 years later. And if you're halfway into it and you look and go, oh no, rents are going down. Am I going to be able to fill this building? By that time, it's too late. You're kind of like, well, I might as well just finish the project. I'm halfway through. People later in the cycle then go, no, we're just going to leave the project half completed and we're taking all the workers off because we know we're going to lose money. We'll lose less money just by bailing out on it. And that's when you're in recession. So a consulting firm, IRR, they take a look at all the major cities across the United States. And they say, where is Minneapolis? Minneapolis is in the first stage of expansion regarding office. So it looks like there's some room to grow in the commercial real estate side. for the Twin Cities in office. How about apartments? Apartments seems to be going into hypersupply in the Twin Cities. We've built a heck of a lot of apartment buildings over the last few years, and they're continuing to build them. So that's a little bit of a warning sign about a future recession. What's going on in the Minneapolis area? This is ranked the top 10 transactions that are happening for apartment buildings across the United States. Minneapolis is third in the amount of transactions that happened last year. So we're really a hot market, and that's what's kind of driving us towards the hypersupply side of the cycle. Industrial has been great. It got us out of that terrible recession. They were producing expansion amounts in that area for a long time. What has happened? The dollar's gotten strong, which makes their products less competitive on the world markets. They're facing more competition from the foreigners. Industrial is starting to level off, to go down a bit, which should eventually reflect that in the industrial market. Here's a picture of the dollar over time, trade weighted. And you'll see that the dollar took off in 2014. And has anybody been lucky enough to go overseas and spend our strong dollars? Nobody? All right, where'd you go?
2 years ago, Greece. Last year, Ireland.
Greece and Ireland. And did your dollar go far? Yeah. It's been great. I've been to Thailand, I've been to Korea, I've been to Japan, and I'm meeting all these expats over there. Like in Thailand, this expat, he's living off of Social Security. He says he hasn't poured himself a cup of coffee in 2 years. It's $300 a month to have your servant do your shopping, do your cleaning, do your cooking, do your driving. $300 a month. What's the cost of a meal? $1. So the strong dollar is incredible when you go overseas. Now, when you look at the goods there that they have, you can buy a purse for $1.50. Now imagine when they had the transportation costs and they bring it here, if you're trying to make purses here, not that good, right? It's great for consumers though, keeps the inflation low. Let's take a look at China. I want to mention China. Oh, you have a question?
What about the value of the dollar in Europe and the UK?
The value of the dollar in the UK, you could ask Google, I suppose. I can look it up on a sheet of old paper. 1.41 for the pound. And what is it for the euro? 1.13, so $1.13 for a euro when it used to be $1.40, right? How about the Canadian dollar? Is that like 77 cents? Remember, that was over $1. Let's turn to China. China has been huge. They've had tremendous growth, and the growth they've had is, let's invest in machines to make more machines. Let's invest in factories. Let's invest in mines. Let's invest in stuff to produce more stuff. This chart here shows the annual percent growth from 2000 to 2014. Mining equipment, 20% annual growth. Every year, 20% increase on the previous year for mining equipment production. Power generation, 19%. Metal cutting tools, 12% annual growth. That's the bottom part, which shows that they've been just building more and more factories and more manufacturing plants. The top part shows their capacity utilization rates from 2008 to 2014. Steel went from 80% to 70%. 80% to 70% of capacity utilization. Meanwhile, they're making more factories. So they've grown from a small sliver of steel production 20 years ago to like half the pie now. They're going to cut more production this year in steel than the United States produces in a year. That's another reason why inflation's so low is they've built up to produce a lot of stuff, and now they're finding that there's not many customers for that, especially domestically. Okay, so for the short term, the economy should continue to grow. We expect the economic expansion to continue, but watch out for risks. Is China going to all of a sudden implode? Are we going to have a drought for agriculture? Are we going to have fiscal or monetary issues? Could we get unlucky? So overall, this year, expect economic growth. Now, the midterm economic outlook is really scary. Really, really scary. Why? Labor force isn't growing. We have big promises to pay out trillions of dollars, the government has, and we're going to be facing higher interest rates at some point in the midterm. 1 year out, 5 years out, it's going to happen. What's happening with labor force? Back in the 70s, labor force was growing at about 3% clip in Minnesota. That was great, right? Because every year you could be a financial planner, you could be an insurance salesman, and you could be like, I got 3% more customers this year. And next year, I got 3% more customers just from the population growth, just from the workforce growth. Last 5 years, we've only had 0.5% growth. These next 5 years, only 0.3% growth, and then 0.1% growth. In other words, you can't just sit back and do the same old thing and expect all this natural growth to happen because the workforce isn't growing. Now, the really scary thing on that is recessions. Recession, the economic output, if the workforce isn't growing, it's all productivity gains. So if you have some shocks to productivity, we could be in recession really quick. Whereas in the old days, if you had 3% increase in people working, you got a big head start on economic growth. You've had a 3% growth in the economy, even if they're producing the same amount of productivity, same amount of output per person. So that puts us at risk of going into recession more is the low labor force growth. How's that happening? Because unfortunately, we're not having fun. Fun is making babies. It's really terrible to die, but we're dying more than we're having babies. So what fills the gap? Immigration. I mean, we have a golden opportunity right now with millions of Syrians that want to move someplace. We could have a big jolt to our economy and produce a lot more if we had a few million more people come in. We would need in Minnesota, just to reach a 0.5% growth in the workforce, we'd need hundreds of thousands of immigrants in Minnesota just to get a 0.5% growth in the workforce. Turning to the big unpaid promises. Medicare, Social Security, those payments are going to increase tremendously. So we got a workforce that's not growing that much, so they're not producing more to pay more taxes. We've got more people becoming retired and needing Medicare and Medicaid and Social Security. So we have a lot more people paying out. On top of that, we have interest payments that are currently $440 billion a year for the federal government, but that's at really low interest rates. When interest rates rise, we're going to have huge bind for the federal government. The federal government's going, wait a minute, my tax revenues are not coming in as much because there are not more people working. I've got to pay out all these Social Security and Medicare payments. And instead of the Federal Reserve giving us $80 billion a year to help cover the $440 billion of interest expense, the Federal Reserve's not going to buy any more debt of ours. And on top of that, they're raising rates. We're going to pay a lot more in interest. Congress is going to be in a bind. Debt is growing at 14% a year. So what is Congress going to do? They have three options, right? Or a combination of the three. Borrow even more, raise taxes, spend less. Those three things, or that combination of three things, is what Congress is going to have to deal with, and they're not going to be happy. Now, if they kick the can down the road and they just keep on borrowing and borrowing, then the crash is going to be even that bigger. Even be bigger, bigger, and bigger. If they deal with raising taxes, then you're probably looking at recession. If you're looking at cutting spending, that could possibly hit in the form of a recession. We could have more inflation because we keep on borrowing more. So really what you have to think about, back to the theme of are you prepared to advise your clients about potential outcomes. One outcome is recession. One outcome is inflation. One outcome is continued expansion. If you figure all three of those in, you should be in a sweet spot, like John Dean said, to make even more money because your competitors aren't looking at these options, you are. Now, you might want to think about what some potential solutions are. One is to look at the future of where their jobs are going to be. Change is happening. Here, this chart shows the prediction by somebody, I don't know how well it is, but the probability, they use mathematical models to try to figure out the probability that in 2 decades, in 20 years, what's the probability of a job being there, an occupation being there. Telemarketers, there's a 1% chance, a 99% chance that telemarketers are going away. That's human telemarketers. You're probably clapping going, yeah, no more telemarketers. But what do you get now already? Robocalls. The robots are taking over. Accountants and auditors, only a 6% chance they'll be around. How does that happen? Yeah, how could that happen? Well, if you've got computer programs that if you ask the question of, hey, what happens when I do this? How's that going to affect my taxes? And the answer is, Siri, tell me what the answer is. Or Google, tell me what the answer is. But they'll probably still need accountants and auditors to really do the complex questions, to have the higher value added questions. Real estate agents, 86% chance they're going away. However, if you're a dentist or an athletic trainer or a massage therapist, there's a pretty good chance you're going to be around. Now, on the program, we had a little mix-up. The next session is the breakout sections, and this was advertised as money is power, banking is unstable, and the Federal Reserve is F-cubed. But that's actually happening in the breakout session. This session is on the economic outlook and what's happening in the economy. And the next session will be dealing with part of my book that I wrote about the inside of the Federal Reserve. After 20 years of work at the Federal Reserve, I've got a lot of insights about money, banking, and the Federal Reserve that could help you out.
That previous slide, you flip back. So where are we in that?
Real estate agents, no. So that gets to the main point. The key takeaway is be prepared. Okay, we have about 5 minutes for questions. Does anybody have any questions at all?
We haven't addressed the domestic and political situations and how those are going to affect the economy.
The question was, I have not addressed the political situation and how that's going to affect the economy. So do you want me to talk about politics? That's another thing I talk about without being at the Fed. It's great. So how many people, if they had to vote right now, would vote for one of the 4 main candidates? A few of you? How many would vote for the 5th candidate? More? So it looks like you're going to have a day off on election day. You're going to have to go to the polling booth. You're not going to vote. Or you're probably going to write in your name, right? Because you'd be a better president than these people that are out there, right? Do you want me to do a quick economic analysis of each one? Okay, Bernie Sanders, I like his ideas. I'd kind of look at a cost-benefit from an economist perspective, cost-benefit analysis. It makes sense to have education and healthcare for society because that would increase productivity, increase output. Every speech saying there's going to be a political revolution, that's really bad for the economy. It could be 5 years, 10 years, 20 years before the revolution. It's bad for the economy when you have a revolution. Donald Trump, he isn't beholden to anybody really politically, so he's not going to appoint the head diplomat to Spain who doesn't speak Spanish, like they do now. You know, it's like, oh, you gave me 50 million, okay, which one do you want? Do you want Paris? Okay, you got Paris. So he probably is not beholden to people on who is going to be in the key positions. So he'd probably find the best people to be in the cabinet and the best people to run things. But in my opinion, I've been following him for a long time. I read his book back in the 80s. He's a total freaking egomaniac and he'll destroy the world. Okay, you got that. Then you've got, let's see, Kasich, who I think is like, when you look at everybody else, he's like, this guy's reasonably just like talks about normal stuff and it makes sense, you know. And then you have Hillary. Hillary was in the White House for 8 years. She was a senator from New York. She was a Secretary of State. So you kind of look, I probably do the least worst and go with Hillary myself from an economic perspective. Even though I talked to my brother and he's like, but she's a liar. She should be thrown in jail. I'm like, well, just kind of look at their resumes and stuff. If you had to say who's going to run your company, would you put it to somebody that did okay at another company and kind of survived, or would you give it to somebody that totally knew? Anyway, that's my perspective. I don't know if it's good or bad. Now that you do that, please don't kill me. Be prepared. Yeah. Miss Ted Cruz. Yeah, Ted Cruz. That guy. He was the top 4, wasn't he? I don't know. Does somebody want to do an economic analysis of him? What are his costs and benefits with Ted Cruz?
What would the flat tax do to our industry and
Flat tax? Depending on if they got rid of other taxes, which is, as you know, probably a very small chance. When they add a tax, they usually don't get rid of another tax. It would probably make things easier, less need for you all here because it wouldn't be so complicated. We got 1 minute left. Last question.
I like Ted Cruz. However, Ted Cruz said he wants to get rid of the Federal Reserve Board and put us back in the gold standard. I'm like, well, so what would that be?
So the question is, if Ted Cruz's proposal to get rid of the Federal Reserve and put the gold standard, there'd be costs and benefits to that. We had the gold standard for a long time, and what happened was, over a long period of time, we didn't have much inflation. Over 100 years, 0 inflation. But every year we had wild swings. Inflation might be up 15% one year and down 20% the next, and then down again, and then down again, and then way up. So prices varied wildly in the 1800s, year by year. If you take a look at the overall thing, prices didn't change that much. So there's costs and benefits to having a gold standard. All right, well, I'd just like to say that money is power, banking is unstable, and the Federal Reserve is F cubed, which is the next session coming up. I'll have my book available for sale outside for $19.99. I've got to put a shameless plug in for that. But otherwise, again, the key takeaway is be prepared.